Hello, I'm Zoe Brunson, Chief Investment Strategist at AssetMark. After the first quarter of geopolitical tensions and market volatility, we need to make sure we have a plan to deal with that ongoing uncertainty. While every situation is different, we can look back at history to see how the markets reacted and responded to geopolitical shocks. We're showing here the performance before and after each political shock, and on the right, the average of all events. The telling story here is that the market digests the shocks and tends to show resilience over the subsequent time periods, with positive returns in each subsequent 3-year period. It's a reminder not to let scaremongering headlines drive long-term investment decisions, as the equity markets tend to be more resilient. The geopolitical events of the first quarter resulted in a market fall of over 9% from the January high. While 2022 was somewhat of an anomaly, given the rapid rise in rates, historically bonds have provided a ballast to a portfolio during equity market declines. The deeper the fall in the equity markets, the greater the difference in returns between equities and bonds. We now have a Fed on pause in their rate cutting cycle, and rates have been somewhat range-bound since 2022. Active managers that have a greater flexibility in their approach provided stronger relative returns and surpassed the returns of money market funds. Instead of sitting in cash while the Fed is on pause and rates are in a range-bound cycle, look to add ballast to the portfolio with actively managed bond strategies. Bonds are a key ingredient to providing ballast to a portfolio, but they're not the only ingredient. The table looks back at each month the equity had a negative return over the past 5 years, and in most instances, bonds outperformed equities during those months. But note that alternative strategies generally outperform bonds. Looking across the full 5-year period and the results of the core bond index compared to the actively managed strategies, it's clear to see that alternatives generally provided stronger returns and provided diversification benefits as a part of risk management. Low correlation to equities and not being so sensitive to moves in interest rates allows alternative strategies to be a good complement to bonds in managing total portfolio risk. Market volatility is never fun, but it does mean the market is operating well. The daily ups and downs are like a heartbeat monitor showing the market is alive and kicking. During periods of uncertainty, though, we need to remind ourselves that we invest in equities for a premium, and the uncertainty is a driver of that premium. Secondly, when we try something new, like a diet or playing a new sport, sticking to the plan and being disciplined leads to the best results. The same is true for our investment habits. Third, unless your goals have changed, there's no need to change your plan for some near-term turbulence. It's like being on an airplane and you hit some turbulence. You may be shaken for a short time, but you can't get off. But instead, stay focused on making it to your destination. Fourth, one of my mottos for life is focus on what you can control rather than worrying about what you can't. It will save you a lot of wasted energy, and in investing, it will save you a lot of emotional decisions. And fifth, keeping things simple and making sure you have sound diversification in your portfolio can be a winning strategy. Not every strategy performs well all of the time, which is where diversification is critical, especially during times of uncertainty. Asking questions about your portfolio and whether it's well diversified across equities, includes active management and non-correlated strategies is key to long-term success and should be discussed with your advisor. At AssetMark, we believe in going beyond asset class diversification into strategy diversification to help investors meet their long-term goals. A foundational position that aligns with your risk appetite is the core of the portfolio, and to which we add more strategies across equities, bonds, and alternatives to better align with your goals. Most core positions today will likely have a US bias and subsequent growth tilt to the portfolio, given the concentrated nature of the US market. The core position can be supplemented by blending 2 equity strategies: a differentiated growth strategy that is more global or focused on broader disruption, and a lower beta strategy that tends to have lower volatility from being invested in value, dividend equities, or tactically adjust the level of equity risk taken. Here, we show some examples of strategies on the AssetMark platform that represent these areas. For additional bond exposure, look to include strategies that are actively managed, taking advantage of credit selection or sector rotation, and can include exposures that are not in the traditional core bond. This could include exposures to high-yield loans, emerging markets, or other sectors that enhance return or yield potential. On the AssetMark platform, we have options for investors seeking return, income, or lower sensitivity to interest rates. To help with risk management, alternative strategies that tend to move in different directions from the equity markets can be additive to the portfolio. Key here is to use strategies that are diversified and not tied to just one approach. There are 3 strategies that provide diversified exposure available on the AssetMark platform. To bring these ideas together, we share a couple of sample portfolios that add complementary strategies to that core 60-40 position to provide diversification across equities while also including active bond management and alternatives for risk management. The model-based portfolio consists of ETFs and mutual funds, while the SMA-based portfolio consists mainly of individual securities and subsequently requires a higher level of investment. We close with our reminders. Uncertainty is a reason there is a risk premium. Having discipline and a long-term plan is key to success, focusing on what you can control and remembering keeping things simple. And just remember, not taking action is a decision, especially if you've worked on putting a diversified portfolio together with your advisor. Thank you for listening, and if you have any questions, please reach out to your financial advisor.